The second quarter of 2025 was defined by policy uncertainty, trade shocks, geopolitical risk, and cautious central banking. Growth was sluggish, inflation was resilient, meaning all markets were volatile. No one expected the advent of Trump 2.0 to be dull, but few could have predicted the chaos that was inflicted as a result of Liberation Day. As a result, the first week of April saw heavy falls across global investment markets, and market volatility reached levels not seen since the Great Financial Crisis or COVID. However, tariff policies were swiftly put on hold for 90 days following a sharp sell-off in the US government bond market. This saw the beginnings of a relief rally. During the second half of the quarter, there was further positive economic news. The UK agreed trade deals with the US, India and the EU. UK GDP grew by 0.7% in the first 3 months of the year. The Bank of England trimmed rates by 0.25%, and the ECB cut rates by 0.25%, meaning that European borrowing costs have halved to 2% over the past year. As we move into the second half of 25, markets and policymakers will continue to closely monitor progress on tariffs, inflation, the oil price, and wider geopolitical uncertainty, such as in the Middle East and Ukraine. We expect that heightened volatility experienced in the first half of the year, however, to persist. The second quarter saw dramatic yield swings from reactive bond buying to rapid sell-offs, then partial retracement. There were signs of stress across markets reflecting fears over government finances and central banks' credibility across major economies. Investors remain cautious with global bonds offering relative safety but carrying elevated duration and fiscal risks. Covered and corporate bond issuance remained solid, yet spreads widened amid the uncertainty. Still, underlying investor demand for income and diversity continued to support fixed income markets, and most bonds delivered positive returns across the quarter. Q2 saw global stock markets experience a roller coaster journey following Liberation Day. Stock markets plunged, such as the top 500 stocks in the US, which fell over 15% in one of its worst weeks in 5 years. However, following the 90-day tariff reprieve, major indices recovered much of their earlier losses, and by the middle of May, the US market returned to year-to-date positive territory, although not when you calculate in sterling due to the weakness of the US dollar. A noticeable sector rotation occurred in the second quarter, with both technology and many growth stocks weakened, while defensive sectors such as energy, health and financials gained favour. Despite the volatility, global equity markets overall ended Q2 with good gains and above the April lows, with emerging markets and international equities outpacing US benchmarks. The case for a well-diversified portfolio is now stronger than ever whilst we tiptoe through these volatile markets. There are potential risks associated with both equities and bond markets as central bankers grapple between sticky inflation and weakening growth. However, by blending equity styles with flexible bond managers and increasing allocation to alternative investments where possible, we feel the models are well positioned to withstand most market environments. We expect that the heightened volatility experienced in the first half of the year to persist. However, we hope the market continues to play a crucial role in guiding the US administration towards sensible policies. The risk is that uncertainty of US policy leads to both firms and consumers to pause their spending plans as they wait and see how things work out. Tariffs is one example of this policy uncertainty. The good news is that the global economy is sound and has defied fears of recession despite soaring inflation and interest rates, thanks to healthy corporate and household finances. In equities, we believe that unlike the last few years, investors will see better risk-adjusted returns from being well diversified regionally rather than simply having a big exposure to the US stock market. As well as being regionally diversified, both income-focused and the use of funds with different investment styles should help guard against further wobbles in the equity markets. Bonds are an important component of portfolios, providing both income and downside protection during those more volatile periods of the equity markets. Our fund managers think the UK gilt market is best placed given a relatively weak growth backdrop and a UK government that must act according to its own fiscal rules. Within the credit markets, with spreads down at reasonably tight levels in investment grade and high yield market, stock selection is critical. Alternatives also provide an additional layer of diversification, so given the uncertain economic growth and inflation backdrops, they should provide a stabilising component.